Picture this moment with me. It's 2:30 p.m. on a Tuesday. You're hunched over your trading desk, three monitors glowing, charts everywhere. Your finger hovers over the buy button on what looks like the perfect setup. Every indicator is aligned. The pattern is textbook. Your analysis says this trade has a 70% probability of success. You take the position, 500 shares at 47.23. Within minutes, you're up $200. Your heart starts racing. This is it, you think. This is the trade that's going to change everything. The price keeps climbing. $400 profit, $600, $800. You're not just watching numbers anymore. You're watching your dreams unfold in real time. Maybe you'll finally pay off those credit cards. Maybe you'll take that vacation your family has been begging for. Maybe, just maybe, you'll prove to everyone who doubted you that trading isn't just gambling. Then without warning, the market hiccups. A single red candle appears, then another. Your $800 profit becomes $600, then $400. Your palms start sweating, your chest tightens. It's just a pullback, you tell yourself. It has to bounce back. But it doesn't. The price keeps falling. $500 profit becomes $300, then $100. Now you're breaking even. Now you're down $200, $500, $800. If you've lived through this exact nightmare, if you felt your stomach drop as profits evaporated before your eyes, smash that like button right now. Because today, we're not just talking about this problem. We're solving it permanently. Here's what happens next. And I know this because I've received thousands of messages from traders sharing their stories. You panic. Logic flies out the window. Instead of taking your predetermined loss and living to fight another day, you double down. You convince yourself this is just a temporary dip. You add to your losing position. I'll average down, you rationalize. When it bounces back, I'll make even more money. But the market doesn't care about your rationalization. It keeps falling. Your small loss becomes a devastating blow. Your account, which took months to build, gets wiped out in a single trading session. Sound familiar? If you're nodding your head right now, you're not alone. You're not weak, stupid, or destined to fail. You're simply human, trapped on what I call the trading emotional roller coaster, the invisible psychological force that has destroyed more trading accounts than every technical indicator, fundamental analysis mistake, and market crash combined. Walk into any trading education seminar, open any trading book, scroll through any trading forum, and what do you see? Endless discussions about moving averages, support and resistance levels, Fibonacci retracements, and complex chart patterns. Everyone's obsessed with finding the holy grail, that perfect system that will predict market movements with clockwork precision. But here's a truth that the trading education industry doesn't want you to know because it would destroy their business model. The vast majority of trading failures have absolutely nothing to do with technical knowledge. I've personally mentored over 3,000 traders in my career. I've seen brilliant engineers, successful doctors, and sharp business owners, people who excel in their professional lives, completely fall apart the moment they start trading with real money. These aren't people lacking intelligence or analytical skills. They're victims of their own psychology. The market doesn't care about your mortgage payment. It doesn't care that you promised your spouse you'd be profitable this month. It doesn't care about your dreams of financial freedom, your student loans, or the fact that you've been studying charts for 3 years straight. The market moves based on forces completely beyond your control. Institutional money flows, algorithmic trading, geopolitical events, and the collective emotions of millions of participants worldwide. Yet, every single day, millions of traders make the same fundamental mistake. They take market movements personally. They treat wins as validation of their intelligence and losses as attacks on their self-worth. They transform what should be cold, calculated business decisions into emotional warfare between themselves and the market. Let me walk you through the complete emotional cycle that traps 90% of retail traders. Understanding this cycle is the first step toward breaking free from it. Stage 1. The high. Everything starts with a win. Maybe it's your first profitable trade, or maybe you've just hit a hot streak. Dopamine floods your brain. You feel invincible, like you finally cracked the market's code. This euphoria is intoxicating, more powerful than any drug, because it's tied to your deepest desires for success and financial security. During this phase, discipline goes out the window. You start taking larger positions because you're on fire. You ignore your trading plan because this time is different. You skip risk management because you can feel the market's rhythm. This overconfidence leads to bigger bets and reckless behavior. Stage 2, the reality check. The market has a way of humbling everyone, and your hot streak inevitably ends. A few losses start piling up. At first, you brush them off. Just bad luck, and you tell yourself. Everyone has losing streaks. But as the losses mount, doubt creeps in. The confident trader who felt invincible just days ago starts questioning every decision. Stage 3, the desperation. This is where things get dangerous. Your account is down significantly from its peak. You need to recover these losses, and you need to do it fast. Logic tells you to reduce position sizes and return to your original plan, but emotion demands immediate action. You start revenge trading, taking bigger risks to win back what you've lost faster. Stage 4, the crash. Desperation leads to catastrophic losses. You blow up your account or suffer damage so severe that it takes months to recover. The trader who felt like a market wizard is now convinced they're hopeless. Some quit trading altogether, others fund new accounts and repeat the entire cycle. Pause the video for a second and be brutally honest with yourself. Which stage of this cycle are you in right now? Drop a comment below and let me know. I read every single comment, and sharing your experience might help another trader realize they're not alone in this struggle. There's no judgment here. We've all been through these stages. Here's what separates professional traders from emotional gamblers. Professionals don't experience fewer emotions. That's a common misconception. They feel the same fear, greed, excitement, and disappointment as everyone else. The difference is they've learned to make decisions despite their emotions, not because of them. Think about a surgeon performing a life-saving operation. Do you think they feel no stress, no pressure, no emotion? Of course they do, but they've trained themselves to execute their procedures flawlessly regardless of what they're feeling inside. Their hands remain steady, their decisions clear, because they understand that lives depend on their ability to separate emotion from action. Professional traders operate with the same mindset. They understand something that took me years to learn the hard way. Individual trades mean absolutely nothing in the grand scheme of a trading career. Let me give you a powerful analogy. Imagine you're flipping a coin that you know is weighted to land on heads 55% of the time. Over 1,000 flips, you'll make money. But would you get excited when it lands on heads? Would you get depressed when it comes up tails? Of course not. You'd understand that each flip is just one data point in a larger statistical sample. That's exactly how professional traders view their setups. Each trade is simply one flip of their weighted coin. They know their strategy works over time, but they also know that any individual trade could go either way. This perspective eliminates the emotional attachment that destroys most retail traders. Let's talk numbers for a moment, because understanding the mathematics of emotional trading will shock you into changing your behavior. Consider two traders with identical strategies. Both have systems that win 60% of the time, with an average win of $300 and average loss of $200. Mathematically, both should be profitable over time. Trader A follows their system religiously. They take every setup, stick to their stop losses, and let their winners run. Over 100 trades, they win 60 and lose 40. Their total profit, 60 and $300, 40 finds $200, or $18,000, $8,000, and $10,000. Trader B lets emotions interfere. When they're winning, overconfidence leads them to take larger positions that aren't part of their system. When they're losing, fear causes them to cut winners short and let losers run past their stops. Despite having the same underlying strategy, they win only 45% of their trades, with an average win of $200 and average loss of $350. Over 100 trades, 45 see $200, 55 see $350, $9,000, 19 out of the 250 hours, 10 $250. Same strategy, opposite results. The only difference, emotional control. If these numbers are opening your eyes to how much emotions might be costing you, do me a favor, subscribe to this channel and hit that notification bell. I post new content every week that will help you develop the mindset and systems needed to trade like a professional, not like a gambler. It's completely free, and it could save your trading account. Now, let's get into the actionable strategies that will help you escape this emotional roller coaster permanently. These aren't theoretical concepts. They're battle-tested methods I've used personally and taught to thousands of successful traders. Step 1. Radical acceptance of uncertainty. The first and most difficult step is accepting that you cannot predict what will happen on any individual trade. The market can and will do whatever it wants in the short term. This acceptance is liberating once you embrace it. A losing trade doesn't mean you're stupid. It means you experience the inevitable outcome that occurs 30-40% of the time with any good strategy. Step 2. Treating trading like a business. Successful businesses don't shut down because they have a bad day or even a bad month. They understand that success is measured over quarters and years, not hours and days. Your trading account is your business, and every trade is a business expense with the potential for a business profit. Step 3. Pre-trade planning and commitment. Before risking a single dollar, decide exactly where you'll enter the trade, exactly where you'll exit if it goes against you, exactly where you'll take profits if it goes your way, how much you're willing to lose on this specific trade, and what position size aligns with your risk management rules. Write these decisions down and treat them as unbreakable contracts. Step 4. The power of position sizing. The size of your positions matters more than the accuracy of your predictions. Professional traders never risk more than 1/2% of their account on any single trade. When you know that even your worst case scenario will only hurt your account by 1%, it's much easier to stick to your plan and think clearly. Calculate this for your account right now. If you have $10,000, your maximum risk per trade should be $100, $200. If you have $50,000, keep it under $500 at $1,000 per trade. Let me share a personal story. Early in my trading career, I was convinced I had found the perfect strategy. My first live trade was a textbook setup. Everything aligned perfectly. I risked $2,000 on a $10,000 account, convinced this trade couldn't lose. Within an hour, I was down $1,800. Instead of taking my loss, I doubled down. By the end of the day, my $10,000 account was worth $3,200. The worst part? The next day, the market moved exactly as I had originally predicted. If I had simply stuck to my plan and taken my small loss, I would have been profitable. From that day forward, I never risked more than 1% of my account on any trade. I want to hear your story too. What's the biggest lesson a losing trade ever taught you? Share it in the comments below. Your experience might be exactly what someone else needs to hear to avoid making the same mistake. Now let's look at advanced techniques that separate truly successful traders from the crowd. Technique 1. The trading journal with emotional tracking. Track your emotional state before, during, and after each trade. Over time, you'll start seeing patterns and learn to avoid trading during risky emotional states or adjust your approach accordingly. Technique 2. Stress testing your strategy. Know how it performs during the worst possible market conditions. Run simulations during crashes, extended bear markets, and high volatility periods. If you can't handle those numbers in testing, you won't handle them in real time. Technique 3. The power of routine and ritual. Develop a routine you follow before every trading session. Reviewing your plan, checking market conditions, setting daily loss limits, and getting into the proper mental state. Include emotional circuit breakers you will trigger when emotions interfere. One of the most powerful mindset shifts is expanding your time horizon. Most failed traders think in terms of minutes, hours, or days. Professional traders think in terms of months, quarters, and years. If you could achieve just a 10% annual return for 20 years, you'd multiply your initial investment many times over. That requires surviving losing streaks and volatility along the way. Think of proper risk management as emotional insurance. Position sizing and stop losses protect you when trades go wrong. When you know your maximum loss on any trade is small and manageable, it becomes much easier to think clearly and stick to your plan. If you're starting to see how much your emotions might have been costing you, hit that like button and pick one technique to implement for the next 30 days. Then come back and share how it changed your trading. One often overlooked aspect of emotional trading control is the power of community. Consider finding or creating a group of serious traders who can serve as objective voices when your emotions are running high. Remember, the goal isn't to never feel emotions while trading. The goal is to acknowledge those emotions while still making rational, plan-based decisions. This skill develops over time with conscious practice and experience. Every professional trader has a story about the trade that taught them to control their emotions. Your journey to emotional control won't happen overnight, but every small step you take toward better discipline and clearer thinking compounds over time. Master your emotions, follow your system, and watch what happens when you finally step off the roller coaster for good. Your future self will thank you for the discipline you developed today. What's the first step you're going to take today to gain better control over your trading emotions?